Hey everybody, today we're going to talk about the markets, financial markets, and the more broad macroeconomic outlook for quarter 4 2025 into early 2026. And I ran some simulations, like a couple thousand simulations using Monte Carlo style scripting to see what would happen in the future with any likelihood, and I have the results, so I think they're worth sticking around for, and it will get towards the end. We'll talk about that. But growth in the United States has slowed from mid-2024's 3% pace to roughly 2% in 2025. Inflation, though easing, remains above target and stuff like that. The Fed has signaled a pause in rate cuts. Markets expect the federal funds rate near 3.5% to 3.75% by end of 2025. Unemployment recently ticked up 4.3% in August 2025 as per sources. As labor demand cools, even with stimulus, e.g. the new Budget Act and resilient AI-driven investment, real income and consumption faces headwinds from tariff and tighter policy. The euro area has sluggish activity. IMF forecasts only 1.2% growth in 2025. So inflation is roughly at the 2% target and is expected to average 2.1% in 2025 and decline into 1.7% in 2026. Unemployment in euro area is moderate, around 6.3% in August 2025. WEO forecasts project growth around 1.1 to 1.2%, which is, not all that great. And such things. Persistent trade headwinds and an appreciating euro pose downside risks to exports. So for those dealing in exporting, that will adversely impact them. China has moderated their growth. The IMF projects 4.8% GDP growth in 2025, down from over 5% in 2024, supported by fiscal stimulus and a competitive exchange rate, but held back by a property sector slowdown. Official urban unemployment is low, about 5.3% in August 2025, where inflation is subdued near zero to mid-single digits in China. So the PBOC, the Bank of China, basically has eased policy modestly. Rates are at multi-decade lows and policymakers have room to cut further to support demand. Japan, whereas Japan is in a different position, we'll take a look at that right now. Growth has picked up from near zero to roughly 1.1% in 2025, so I suppose that's something. Aided by a big fiscal stimulus and strong auto exports, core inflation has been above 2%, prompting the BOJ's exit from negative rates. The BOJ raised its policy rate to 0.5% in January 2025, with plans to gradually hike towards 1.5% over the medium term. Unemployment is very low in Japan, 2 to 3%, and wage growth is firm. So overall, the global economy is projected to grow about 3.2% in 2025 and 3.1% in 2026, down from 3.3% approximately in 2024. Whether this is actually the case, we'll have to rely on the sources which say it is. That's where the simulations that I ran come in to play later, so we'll talk about that. U.S. inflation is higher than expected, while Europe sees faster disinflation. Uncertainty is unusually high. And so here I suppose, with the uncertainty unusually high, my bad, my microphone messed up and stuff. Alright, so We're going to look at volatility clustering. Markets are more likely to see volatility clustering in Q4 2025 to 2026. After large shocks, e.g. policy surprises or geopolitical flare-ups, implied volatilities tend to jump and stay elevated. For example, in 2023, the surge in U.S. interest rates triggered a bond market dislocation in the UK, where they're called gilts, and bouts of equity turmoil. We therefore incorporate GARCH-like dynamics in our simulation, where a large realized return increases next day volatility, so that we model the simulation properly. I'm discussing the parameters that I build the simulation with. So then investor behavior is another factor considered. Amid stress, investors tend to flight to quality, safe haven assets like gold, silver, U.S. treasuries, and defensive currencies such as USD, JPY, and CHF have been bid up. As one market analyst notes, gold's rally reflects fiscal instability, safe haven appeal, and geopolitical tensions in markets. Conversely, risk assets suffer from sudden drawdowns. The combined effect of uncertainty and policy risk is to make equity and credit markets prone to sharp swings by nature. The next thing we factored into the simulation were commodity signals. So the commodity price ratios signal stress. The gold to copper price ratio, a common barometer of risk-off conditions, has jumped to levels last seen in 2020. This reflects unusually strong gold prices, which are driven by safe haven buying, and relatively weak copper due to sluggish global growth and demand for industrial production. Historically, spikes in the ratio have preceded economic slowdowns or mere crises. Meanwhile, other base metals and oil remain under pressure from slower demand. The price of Brent has largely traded sideways in 2024 to 2025 after big swings in prior years. Consumer and political feedback we also factored in. High inflation has already changed people's attitudes, so consumer attitudes. Many households are less tolerant of real wage declines after recent cost of living shocks, suggesting that political pressure for income support or rate cuts will be strong. If inflation persists above target, trust in central banks could erode, which would in turn unanchor expectations and further fuel volatility. Conversely, a sudden downturn from, say, a tariff shock could quickly deflate inflation pressures, forcing a difficult policy pivot. So the factors play into each other. And so with this outlook, we head into the simulation. Now, we made some assumptions that the baseline drift is about 2%, realistic volatilities, so 20 to 25% about annually, with clustering. We modeled daily returns with a GARCH 1 volatility process so that large moves breed higher future volatility. We add jump risks like Poisson shocks to capture rare events, e.g. if a conflict or policy shock hits, right? Returns can jump sharply. We assume around 1% chance per day of a jump with typical size 4 to 5%. We also include cascading effects, so if the market drops by 7% or more in a single day, we elevate volatility in subsequent days. So that's basically how I ran the simulation. Now let's get to the actual values that we return from it. The simulated distribution after like 1,000 times of gaming it out shows us this. Simulated value mean return will be around minus 0.1% for the average or for the economy itself. Median return will be negative 2.7% with a standard deviation of about 25.3%. skewness of 0.89%, and the probability of loss exceeding 50%, 54.4% to be like exact. So yeah, that's kind of worrying in my view. I think it reflects a broader symptom of something other than just economics. That's why I thought I'd talk about this. So if you like this video or learn something from it, please like, comment, and subscribe. And yeah, so thanks. If you enjoyed, I hope you enjoyed the simulated 1-year returns for a global risk index. We did 5,000 Monte Carlo trials, and I'll be back with more if you'd like better and more consistent, similar content to this, whereupon we see what probabilistically could happen.